Okay, so hi everybody. I'm Matthew Burke, partner here at Cerini Associates. I've been with the firm for about 20 years now, dealing mostly with nonprofit organizations in my day-to-day life, auditing, tax considerations, consulting work, all sorts of different things. And obviously, you know Cerini Associates by now. We're a nonprofit-centric accounting firm who hosts this nonprofit update on an annual basis. And one of the things we always talk about, because we're geeky accountants, is any changes to the accounting regulations that affect our clientele and nonprofits. So we have a pretty full agenda here today. We have about 45 minutes. Might not get to everything, but it's okay. It's in order of importance and I guess timeliness. First, we'll talk about some COVID-19 funding, new issues or new subjects there. Then we'll get into some of the new auditing standards that have changed, SAS number 142 to 148. We'll spend a good amount of time on the new lease accounting standards because those actually apply now. We've been dealing with that with our clients for the past year or so. It's still not a well understood area. Then we'll get into goodwill, and then the major upcoming change that affects the year we're in now, 2013 and forward, is CECL, credit losses. That's ASU 2016-13 through others. And then we have some others that are probably not overly relevant to everybody listening, but they are out there: defined benefit plans, reference rate reform, and then supplier finance programs. So we'll get into all that. Before we get into that, though, I do want to touch on a couple of issues that we still see for a lot of our clients, and that's accounting for revenue recognition and contributions. So there were some changes to that recently, 2019 and forward, that we're still rolling out. We're still educating our clients on. So if that's something that you're not familiar with, you should be by this point. And if you don't feel strong in that area, let us know. We're happy to educate you further on that. But with that, we'll get right into the COVID funding. So COVID is thankfully mostly behind us, I would say, and I always knock my wooden desk here when I say that. What we've seen for most of our nonprofit clients is that there were some positive financial consequences as a result from COVID. So the federal government was printing money, right? $4.6 trillion that was released and given to the nation in different ways to help recover and cope with COVID. There were 6 relief laws that were enacted in 2020 and 2021. Everyone knows about PPP loans, the CARES Act, ERTC, provider relief funds. There's other programs. Unemployment insurance was expanded, and all sorts of others. So as of January 31st, 2023, the Government Accountability Office, GAO, they performed an in-depth analysis of the COVID funding and where it stood. And most of it was expended or appropriated. There's still about $90 billion that was available. So it was unobligated and unexpired that still could be tapped into. We still see a lot of organizations asking about the ERTC, it's Employee Retention Tax Credits. That's something to make sure that you're well aware of. There is money that's still on the table, still potentially could be gotten. It's based on revenue declines that may have been experienced during COVID. And there's other qualifications too and quirks that have to be ironed out as part of that. But if you haven't explored ERTC, you should. We can do it for you. Reach out to us. We've done tons of these. We've got a lot of dollars back for our clients that they didn't realize they could have gotten. So that's something to keep in mind. The highlights of the report from the GAO, though. So tracking federal spending obviously is complex. There's frauds that were identified in the PPP loan program, ERTC also. So you have to be wary of who you're dealing with when it comes to those things. But more importantly, a lot of the money was used. $4.5 trillion has been obligated. 4.2 trillion has been actually issued. And like I said, only about 90.5 billion is still out there. But the moral of the story here is ERTC still out there. Most everyone's gotten their PPP loans already. And then on the next page, we get into provider relief funds, which is still out there also potentially. So provider relief funds were designed to help organizations that deal with health and human services more than anything. So healthcare providers who bill Medicaid and Medicare, one, defray costs that were incurred to deal with COVID. So additional COVID expenditures for cleaning and maintenance and things like that may have sprung up, or other programs. And two, to help offset lost revenues. So obviously when COVID happened, organizations were shut down either physically or just implicitly because no one was going there because people weren't meeting in person. And as much as you had virtual events and things like that, it just wasn't the same level of volume. So a lot of these healthcare type organizations had lost revenues, and the provider relief funds were intended to make organizations whole, right? And sort of subsidize and offset those lost revenues that were in place. Funding is administered by the Health and Resources and Services Administration of the federal government. that means that uniform guidance audit requirements would exist for recipients who spent more or received more really than $750,000 in a reporting period. So different reporting periods below. This is a pretty complicated program. It's simplistic on the surface in terms of how to qualify and what to do with the funds. But the reporting mechanism is a bit convoluted. There's an interactive portal online that you have to go through. And you can see here, there's different dates here, depending on when funds were received. There's certain requirements for the eligibility of expenses that would have been incurred or the period of lost revenues. They've closed the period for lost revenues as of June 30, 2023. The public health emergency supposedly has ended or will end then. So you can't really apply lost revenues past that point. And then there's reporting time periods that you have to be aware of to make sure that you're reporting all compliance with the grant components from the federal government. Really check out that website. There's a lot on there for the provider relief funds. Just Google that and it'll bring it right to where you have to be to describe the program. Or like I said earlier about DRTC, we're happy to help anyone with this. We've dealt with a lot of the clients that have received these funds and had to report these funds, and we've had to audit them, properly reporting and using those funds. Next group of updates from an accounting world standpoint, really these are auditing standards updates. So there's so many different regulatory bodies in place. One of them, and who we answer to as accountants and auditors, is the AICPA, the American Institute of Certified Public Accountants. They're the ones who promulgate auditing standards that we have to follow. So they tell us how we have to audit within reason. And they issue these statements on auditing standards. We call them SASs for short because we love acronyms as accountants and auditors. So there's new SASs, SAS 142 to 148, that will be effective now and in the future, rolling out in the next few years. So you can see 142 is effective already for calendar year ends of 2022. 143 to 145 will be effective for this year we're sitting in, 2023 calendar year ends. 146 is for 2025. 147 is for 2023 fiscal year ends, and then 148 is also partly effective now and partly effective in the future. I know it's a mouthful and it's convoluted. That's how the AICPA and the FASB seem to do things. The point here and the moral of the story is there's no significant outward changes to reporting. If you are in an audited organization, you would have noticed in the past couple of years that the audit opinion changed slightly. You'll also notice that the required communications that auditors have to give to you at the conclusion of audits has also changed slightly. We have to make it more clear about non-attest services, about significant auditing risks and things like that. We're happy to say, though, that these SAS updates won't result in any of those outward-facing, client-facing, nonprofit-facing changes. It's more behind the scenes and things that we have to do as auditors to make sure we're complying with our own standards. This may, though, make the audits a little bit different than they have been in the future, in the past, going forward in the future. Really, there's an enhanced focus on audit risk. Everyone proclaims to be a risk-based auditor, meaning you spend more time on issues and areas that are riskier and more subject and prone to fraud, misstatement, error, compliance issues, stuff like that. So we may see that there's more time spent in that area. It may result in more questions for you as a nonprofit organization about that. There's greater emphasis on what constitutes proper audit evidence, especially with respect to the use of technology. So you should see, if we're not your auditors, if someone is more use of technology going forward, and in recent years, really, that can be in the form of workflow online, getting digital documents. A lot of audits are entirely remote, if not mostly remote now. There's a lot of sharing of information back and forth to make sure that we're getting proper documentation if we're not physically sitting in offices and looking at what's right in front of us. Assessing the IT control environment is also very important in this new world that we're living in, where things are more remote, more digitized, and more sitting in the cloud instead of on local servers or in file cabinets somewhere. So that you'll see more of a focus on in your audits too. There's some internal revised requirements about maintaining audit documentation that won't affect you as an organization, that will affect CPAs. I know there's some CPAs that aren't working for us on this call. And then increased professional auditor skepticism and more internal monitoring and self-assessment. So your auditors have to go through a peer review process once every 3 years. Peer review is an independent CPA firm who is hired that looks at the system of quality control for the auditors to make sure that they're complying with all these different standards. So there will be enhanced requirements for internal monitoring associated with those peer reviews, making it more of an internal type peer review, which has always had to be done. They're just trying to clarify things and impose more forceful suggestions as to what we have to follow there. So really not a whole lot that would affect nonprofit providers themselves, more so work for the CPA to deal with. The new lease standards now. This is what we've been dealing with a lot in the past 12 months. So it really goes back to 2016, the FASB. So that's the Financial Accounting Standards Board, another acronym. This is the governing body. They're an independent nonprofit group that maintains the accounting rules in the United States that have to be followed by literally everybody, including nonprofits. So in 2016, the FASB issued a whole new codification section, topic 842, superseding all prior lease accounting rule standards adopted under topic 840. What does that really mean? It means that there's new lease accounting standards that take place and have been in place for public companies and other types of entities. It's now finally hitting private companies and nonprofits that aren't considered public nonprofits, meaning they don't have municipal bond obligations or something like that. So per the most recent ASU, Accounting Standards Update in 2020, non-public entities, including nonprofits, could delay it now to calendar 2022 year end or fiscal 2023 year ends. So we're literally dealing with this on all of our clients now. Early adoption was permitted, wasn't really encouraged because it is something that creates a burden administratively, accounting-wise, finance-wise. And really what's happening here is that, we'll walk through step by step, but the short story here is that what used to be just an expense on your statement of activities, your statement of functional expenses for rent payments, now has to be looked at and made sure that you don't have to also record an asset and a liability associated with the contract that you have for renting space. It's usually space, but it does apply to all leases. So we'll walk through the different qualifications here and describe the differences in the current accounting pre this topic 842 and now it's changed. So really, what's a lease? A lease contract or a contract is or contains a lease when two criteria are met. It's if the contract explicitly or implicitly specifies the use of an identifiable asset and the customer, the lessee, controls the use of the asset for that period of use. So it's basically saying that if you're leasing space for 10 years, you have control of that asset, you have rights to that asset for that 10 years. It should be an asset on your balance sheet. It should be a liability offsetting that for future payments that are required. It shouldn't just be an expense that doesn't hit your balance sheet. When adopting, comparative statements must be restated. So this is something where you have to typically go back in time and restate for leases that were in place. There's certain practical expedients, they call them, where you don't do this, but we're recommending that everyone really go back and take a look at your current leases that are in effect, if they're significant, if they're long-term in nature, and restate. They would require a restatement, usually to net assets, maybe modifying prior year financial statements and disclosing in the financial statements that you've adopted this new accounting standard and it's had an impact on your prior year financial statements. So it's worth noting that the new lease rules do apply to substantially all leases, but there still is a distinction between operating leases and what's now called finance leases. If you recall, prior, there used to be operating leases and capital leases. So capital became finance, operating is still operating. There's a distinction there because there are different recognition rules for the asset liability, the related expense, and the presentation on the cash flow statements there. So you still have to go through that process. So lessee accounting here. In short, lessees will recognize all leases, including operating leases, with a term greater than 12 months on the statement of financial position, your balance sheet, with what's called a right of use asset and a corresponding lease liability. This is calculated really as a present value discount type thing where you take all the future cash flows associated with the contracts. If it's a 10-year lease, it's monthly payments for 10 years, discounted to present value using some sort of interest rate, whether it's a risk-free rate or a stated rate, something like that. And that all sort of imputes and calculates this liability. And the liability is used then to record the asset. So we'll walk through that in the next page too. A key takeaway here is that these new assets and liabilities will affect or could potentially affect measures and ratios that are based on your financial position, right? You have certain liquidity measures, working capital, current ratio, things like that, that never had an asset or liability associated with leases in there. So this could get involved there and it could screw up some of your ratios, which could affect organizations that have certain covenants with lending and debt arrangements for lines of credit and things like that. So you have to make sure that as you're adopting this, you are aware of the potential impact on your financial statements, which could have a domino impact on different things involving your actual business and not just from an accounting standpoint. So basically how to do this, at lease commencement, the lessee, so that's whoever is leasing, receiving the benefit of the asset, will determine if a lease is either a finance or an operating lease based on the 5 criteria. These are similar to what they used to be for capital leases. It's just called finance now and repurposed. So if there's any explicit purchase transfers, ownership transfers, bargain purchase options. If you're leasing the asset for the majority of its economic life, that sort of suggests that it's a finance or capital type lease. If the asset has a very specialized nature, so no one else can use it, it's more of a finance lease. The present value of all the lease payments exceeds the fair value of the asset. It's a finance. So basically, if you're using the entire asset, or if you have direct control of it, if you're getting it, on the cheap, it's a finance lease. If not, it's generally an operating lease. So how do we account for this and how do we record it? So I mentioned quickly before, the lease liability is what really starts the equation, and it's supposed to represent the present value of the unpaid lease payments in the future. It's always easiest to think of this with a new lease. So I use the example of it's 10-year lease, you have 120 payments, build a giant spreadsheet that we could share with you and walk you through, show those different payments, discount to present value, and that gets to your liability. So these lease payments, it's worth noting, exclude variable contingent payments and must be discounted at the rate either implicit in the lease if it's available, but most leases don't really explicitly or implicitly calculate any sort of financing component or interest rate. So if that's the case, you may determine a single discount rate for a portfolio of similar type leases for the terms in place for the lease, the length of the lease. So that's something that you can do relatively easy. There's a lot of resources online about this, but again, you can lean on us. We can provide templates for how to calculate this liability so you're not building it from scratch. Now the asset is the other side, and the asset is really just based on the lease liability. Typically, you add in any other additional indirect costs of obtaining the lease. If there's any prepaid payments, you add them in, or if there's any incentives received, free rent or anything like that, you reduce that from the right of use asset. So it has a narrow definition of what initial direct costs are. So it includes those costs that are directly attributable, as you would expect, to obtaining the lease, would not have otherwise been incurred. So it's not indirect stuff. It's not really considering, salaries, advertising leases, unsuccessful origination efforts, anything like that. It's more of what's directly related to securing and building that lease. So that's how you get the lease on the books. You'll have an asset and liability, which pretty much offset to start. And then subsequently, for a finance lease, the right of use asset is just amortized on a straight line basis over the lease term. The liability is reduced as it would in any sort of term loan type arrangement with principal and interest being charged off. So that's pretty easy. Operating leases, we typically recommend method one, and that's what we're seeing with all of our nonprofits. So we'll spend time there. So the right of use asset amortization is the difference between the straight line single lease cost for the period and the periodic accretion of the lease liability. So that lease liability, because it's been present valued, each month as payments are made, part of that lease liability will sort of evaporate and go into a lease expense account based on the present value amortization. So again, that's built into the spreadsheets that we can share with you that everyone's making themselves. So your lease expense is really going to be partly the amortization of the asset, and then also partly the imputation of the liability associated with the payments being made and the present value discount going away. So it is complicated. It sounds worse than it is, though. Once you put it down in Excel, it's manageable. And once the template is built right, the journal entries that you have to record on an ongoing basis are pretty straightforward. It's just something that we're not seeing a lot of organizations do themselves. We're getting involved with most of them. I'd say probably 90% of our clients that have to adopt this are leaning on us to do it for them. But once we set them up, we're kind of setting them off on their way and obviously able to answer any questions about it as time goes on. So the takeaway here is that if you have significant long-term leases, this most definitely applies to you. If you have leases for, let's say, copy machines and postage meters and things like that, this technically applies to you. But unless you're a very tiny organization, they're probably immaterial, and it's probably not worth the effort of going through and calculating all of this because, while the accounting rules are for everything from an auditing standpoint, from getting the financial statements right, obviously we play with materiality. So it doesn't have to be exact. It just has to be very, very close. And I think focusing on significant long-term leases, usually for space, will get you there. If you have vehicles and things like that, that's something you should look at too. But if you have a $100 lease for a copier for 2 years, I wouldn't really waste the time on this because it's not worth it. Other considerations involving ASC 842. Non-lease components. So there's other things written into your leases. You're paying rent usually for space, but there's other things involved, right? Utilities and this and that. Those don't get calculated really, unless they're specifically stated and required and demanded, and a certain dollar amount is spelled out. So it's sort of like rent and it's not a variable number. Otherwise, you really just exclude those. So you're just really accounting for rent here more than anything. The next point is important too, short-term leases. Lessees may elect not to recognize leases with a lease term, including optional renewal periods of 12 months or less, as long as they don't include a bargain purchase option. So some organizations that really don't want to adopt this are going back and looking at their leases and really just signing 1-year leases, and then they don't have to adopt this. I don't know if I'd go that far unless it has a real major financial impact on your balance sheet that could, violate covenants and things like that. I would sort of let business flow and not let the accounting intricacies and annoyances dictate what you do from an operating standpoint here. But this is something we're seeing. And there is interpretation involved. Of course, nothing is as cut and dry as I'm presenting right now. Extensions and renewals come into play. So if a 1-year lease with a 1-year renewal, if it's probable and likely that you're going to exercise that renewal, it's really not a 1-year lease anymore. So you have to consider things like that too. And there are some gray areas involved. That's why I suggest anyone really try to understand this yourselves, but lean on whoever your professionals are, if it's us or someone else, to advise you about how this works. Of course, with any new accounting rule changes, there are expanded disclosures. I see Jennifer Wilson's asking for the worksheet and the leases. Yes, we can share that. Trying to keep up with the chats as I go through. So these expanded disclosures, you always had to disclose lease terms and conditions, extension and termination options, purchase options. So you just have to continue to do that. What's new is certain operating lease costs, the amortization of the finance leases, the ROU assets and interest on the finance lease liabilities. That's all a little bit different. So it has to be disclosed a bit differently in your financial statement notes. It also has to be disclosed a little bit differently in your statements of cash flows, as an add back in the operating section. In the years of adoption, you'd have a non-cash section below because you're putting an asset and liability on the books from a non-cash standpoint. So there's some little quirks here and there that have to be considered too as a result of adopting this. This probably applies to very few of you, if any. But if you are a lessor, so you own property and lease it out to others, tenants or so, whatever we call them, the 842 topic does not significantly change the way lessors have been accounting for leases. So you continue to classify them as you have in the past as sales type, direct financing, and operating leases at lease commencement. There are some changes to how they're classified. Fewer leases will be considered direct financing, and most will be sales type or operating, but really not a huge change here. Minor tweaks are made to the accounting and the disclosure rules, but if you are a lessor, again, try to make yourself familiar with these new rule changes and lean on your CPAs to understand if it has any impact on you. It likely doesn't. There's a new rule that came out in 2023, actually 2023-01. This is for common control arrangements. So a lot of organizations and private companies have multiple entities involved in their consolidated mix, let's say, and there may be leasing arrangements between entities. So what this does is it really says that all entities have to amortize leasehold improvements associated with common control leases over the life of the common control, not the lease term. So let's say there's a sublease arrangement. I'm renting space for 10 years, right, from someone else. And then I sublease it out to an entity that I control. That other entity isn't going to incur leasehold improvements and build out and things like that. And that's a 1-year lease. You wouldn't amortize those build outs over 1 year. You would use the full 10-year that the controlled group is using. So this is providing a better matching of the true asset useful life to the entire group instead of just the technical one entity that's named in the lease as the leasing entity. So probably doesn't apply to anybody here. It's more of a for-profit concept because a lot of entities, obviously they have an operating entity, they may have a real estate entity, right? So the real estate entity usually has a lease and leases out to the operating entity, and the lease terms might not jive, they might not be the same. So I think the reality is a lot of companies and organizations were complaining about this, and that's what led the FASB to issue this one that says, okay, we should be amortizing over the full life of the asset over the longer lease term, not the shorter one. This next rule doesn't probably affect many of you. Some organizations do have goodwill. Goodwill is really an intangible asset. It usually represents the cost in excess of fair value of a business unit or an acquisition or something like that that you may have made at any point in time. Really, the moral of the story here is that for certain organizations, including nonprofits and private companies, there is now relief to the goodwill impairment test. So goodwill as an intangible asset, so it doesn't have a set value that you can just point to. The valuation of that has always been a tricky area. So the whole point of goodwill impairment is if the value of the goodwill drops in the future, you have to write it down to its current fair value. So there's different steps. There's a step 0, 1, and 2 to calculating and dealing with these impairment tests. And really what's happening is it's eliminating step 2 from the goodwill impairment test. I don't want to go too deeply into this, but really what it means is there's a qualitative factor that tells you that the fair value, the current value of your goodwill is less than what is carried on your books. You should go in and perform a quantitative analysis of the business unit or whatever it is that's driving the goodwill in whole. Step 2 would be looking at each individual asset or liability associated with the goodwill and fair valuing each of those two. So this is eliminating that step 2 and thus simplifying this a little bit. But again, this probably doesn't apply to most anyone on this call. This next one does though. So this is CECL, another beautiful acronym that we like to use, current expected credit loss. So this now is affecting 2023 calendar year ends. So this isn't for audits that are currently ongoing, it's for the years you're sitting in, and 2024 fiscal year ends, which are usually June 30th, but could be March or April. So it may affect some of you right now. For others, it will affect you in probably a month or 2 or 3. So really the whole point of CECL, and a misunderstood fact about CECL, is it's not just for lending and banking. It's for everybody and for every type of receivable that really is in place, most every type. So really, it's requiring that bad debt reserves and credit losses be established and calculated based on historical experience, current conditions, and reasonable and supportable forecasts, replacing the previous incurred loss methodology. So prior to CECL, once you know that you have a bad debt, you record it. You may have estimated it and set up bad debt reserves and things like that, but it's more about what actually happened that you're aware of than just sort of projecting out into the future and saying that, I have no reason to think these receivables won't be collected now, but historically 1 or 2% of our receivables haven't come in, or the economy is changing. So I have to factor in the possibility that there's losses there and book a sort of reserve based on that. So it's more forward-looking than it is looking at just what's actually happened. Realistically speaking, this was a major impact on lending institutions, on banks. If you look at the public companies, when the banks report earnings, they talk about this. They talk about their lending, their reserves and things like that, and these major billion-dollar changes in the reserves, which is this. For nonprofits, it's not as important when it comes to that. Some nonprofits get into housing and lending, so it would affect them from that standpoint. But think of your normal receivables, whether you owe tuition or memberships for events, things like that. That counts here too. So you have to look at your receivables a little bit differently than you have in the past and estimate bad debts based on historical experience, current knowledge, and things like that, instead of just recording bad debts when they happen. That's the moral of the story here. So many of the estimation techniques applied today will still be permitted. So a common one is you look at agings, right? If something's current, you have no reserve. If it's between 30 and 60 days outstanding, you may have a 5% reserve. If it's over 120 days, you might say 50%, something like that. So that's what we're seeing more and more of now. And this is going up from an auditing standpoint. We're going to be asking more questions about collectability of receivables and why there are no bad debt reserves on, because most organizations don't really set up bad debt reserves because usually owed money by a small group of donors, a small group of government funders that are good for it, but they just take time to pay. But now, the burden is a little bit higher in terms of proving that there definitely would be no bad debts. And we're probably going to be recommending general reserves of some amount in the future. So what information is considered when estimating these expected credit losses? Borrower's financial condition. So replace the word borrower in your head though with funder or donor or something like that, right? So are people well-funded? Do they have any issues with paying their bills on time? Are they well-financed and capitalized? Can they make these payments to you? Remaining payment terms and maturity dates, how far out are these receivables? Nature and volume of financial assets, severity of past due financial assets, value of collateral if there are any. So we do have some clients that are in affordable housing where they are making loans and they could theoretically foreclose on mortgages, let's say, low to moderate income mortgages, things like that. So what's the value of the collateral? in a potential default situation. And that should factor into how much of a reserve would go on the books for something like that if you're expecting defaults there. Lending policies and procedures, experience, ability, and depth of management and other relevant staff in dealing with this and collecting and being successful. And then environmental factors. Environmental, not necessarily like the physical environment, but think of the economy, local economy, interest rates, inflation, things like that we've seen. You'd expect more defaults going forward, more trouble with collecting receivables. So this is a year where you might see a bit of a spike in your bad debt reserves because things seemingly have gotten worse with the economy, right? Where it was compared to where it was back before COVID, and even during COVID when all those $4.6 trillion of funds, COVID relief funds, were flying around. Disclosures now are enhanced, so every time there's a rule change, there's just more disclosures that are required. So some of the bullet points here. So how are expected loss estimates developed? What are the accounting policies to estimate allowance for doubtful credit losses? We've always sort of had that in there, but now it's just expanding on that and being more explicit about how you're actually calculating, instead of just saying we have a bad debt reserve of X at the end of the year. This is how we develop our bad debt reserve based on complying with CECL. Risk characteristics relevant to each portfolio segment. So this is probably not applicable so much, but portfolio segment thinking types and classes of receivables and things like that. So that I don't want to go through each of these individually, but there's just definitely more disclosures that are required, enhanced disclosures, more requirements to deal with in terms of getting CECL on there. Colleen, you're asking, would Medicaid loss count? Not exactly sure if you want to elaborate a little bit on that, but definitely that type of revenue stream would count. So if there's amounts owed from Medicaid loss billing, yeah, that I think would be a consideration to go into this for sure. So there have been other subsequent ASUs issued having to do with CECL. So this one here, 2018-19, clarifies that receivables arising from operating leases are not within the scope of CECL. So that's within 842, which we just talked about. So there are other certain classes of receivables that don't apply. I think the one that's specifically excluded for nonprofits is pledges. That's something that is not considered part of CECL, but you still have to go through your own bad debt types of analysis there for pledges and contributions and things like that too. And then another one, codification improvements to 2019-04. So again, it's just clarifying some things about hedging and recognition and measurement, related parties. It's not really overly relevant to everyone here. Here's some targeted transition relief. So you can see this CECL has been sort of evolving, and they just keep issuing new standards updates to really quell the masses when they complain about the rules as they're written. So here's another one. For this standard CECL, you're dealing with assets that are not carried at fair value per se. So think of investments and certain receivables. If you're a lender, you might record receivables at fair value. So some organizations are fair valuing assets to get them out of the CECL standard. And this is kind of what this is saying here. So the fair value option does not apply to held to maturity debt securities. So if you have bonds that you're holding in terms of bonds receivable, even if with the federal government or something like that, you'd have to go through the same exercise. And this says that you can't fair value those. You have to consider those as part of CECL also. And yet even more clarification. So 2019-11, more CECL. So here is about recoveries. So you may have heard the term bad debt recoveries in the past. So that's if you set up an allowance or a bad debt reserve in the past, and it turns out it's not going to be as high as you thought in terms of loss. In future years, you'd have a recovery. So this describes in more detail how to account for those recoveries under the CECL framework. So then really not a huge change for these types of organizations that we're dealing with here on an ongoing basis. So getting away from CECL, we get now into something that probably doesn't have a huge impact, but some organizations do have these defined benefit plans. So retirement plans are typically either defined contribution, think of a 403B or 401k, where you're defining how much money is going into the plan. Defined benefit plan is the flip of that. Think of a retirement plan with, government agencies usually, or unions and things like that, where there's complicated formulas that dictate how much money you're taking out at the end. So if you have one of these defined benefit or DB plans, there's some differences in disclosures that will be required. So it was meant to, one, simplify the disclosures and take out some things that are not overly important and relevant. So that's the ones that are deleted. And it does add in some other disclosures there too. So typically this falls on the shoulders of the auditors in terms of making sure the disclosures are what they should be. If you're preparing your own financial statements and footnotes, one, more power to you, that's great. But two, just be aware that if you have a DB plan, the disclosure requirements have changed slightly. Don't expect any material differences or something that anyone really noticed unless they're really reading line by line, year after year. This one may have some impact. So reference rate reform, I'm not sure if people have been paying attention, but LIBOR, the London Interbank Offered Rate, is being phased out. And the reason why this matters to any of us is that a lot of financial contracts are tied to LIBOR. When you talk about variable interest rates and things like that, you know, some lines of credit, they refer to a bank's prime lending rate, things like that. Some refer to LIBOR though. So LIBOR, once it goes away, that leaves a bit of a gap in terms of how these contracts are worded and should be dealt with. So there was an ASU this year, 2022-06, that kind of defers implementation requirements for the sunsetting date of LIBOR and how to account for that. Shouldn't have a major impact on any of the organizations that we're talking to today, but it might. And really what you're seeing is a lot of contracts are being rewritten to use different rates instead of LIBOR. There's other rates that the New York Fed maintains that's become a popular one to use because it's less subject to volatility. And the whole point of this was to do away with LIBOR because it's very subject to volatility, which perpetuated some of the financial crisis that happened in 2008 and 2009. So taking that off the table now, hopefully will smooth out markets and interest rates and the reactions of interest rates and financial instruments. And this is more about derivatives and hedging and things like that than anything else. But it does potentially have an impact on you. So if you have anything, usually a line of credit or some other lending arrangement or something else based on LIBOR, this should put a flag up in your head that you should look into that because LIBOR is going bye-bye and that could have an impact on you. And the last one here probably doesn't have a huge impact on anybody. Supplier finance programs, it's sort of new, and this is, again, I've been glossing over the effective dates. A lot of these don't really matter yet. So this does affect the year we're currently sitting in, but it probably doesn't affect any of you. But a supplier finance program, in short, allows a buyer to offer its suppliers the option for access to payment in advance of an invoice due date. So it's sort of prepaying for things. It's paid by a third-party finance provider or intermediary on the basis of invoices the buyer has confirmed about. So the requirement here is if you're a buyer in a supplier finance program, if you're doing this with someone supplying you, you may have to have disclosures in your financial statements about this, about the program. Amount outstanding, description of the obligations, a roll forward of those obligations from year to year. Like I said, it probably doesn't apply to you, but it might. So if you're doing something like this, just know, again, there may be some changes coming down the pike, may have some additional disclosure requirements and accounting changes related to this. And really with all of this, it's all pretty complicated. If you have any questions about this, you really should be reaching out to whoever you lean on for accounting and financial advice. We'd love it to be us if you're not already a client. We don't really charge extra for that. We just try to educate and make sure that everyone understands what it is that affects them. That being too technical, because this stuff does get very technical. Last page is a way too large picture of me that you should ignore. That's my contact information. Reach out to us if there's anything we can do to help. Check out our website. There's a ton of content online. You're experiencing it today with this NFP update, where we pull together professionals that affect the nonprofit world to help them understand what's going on because things are constantly changing. Unfortunately, the accounting rules are constantly changing too, and we'll bring you up to speed on them. But check out our website, connect with us. There's newsletters that we write. There's seminars and webinars like this that we host. There's past webinars and seminars that you can gain access to. We do an annual nonprofit trends report. We have done board guides, which is just chock full of information that's helpful to board members. We've done webinars for audit committees because audit committees don't really always know exactly what they're supposed to be doing and how. We have the Long Island, New York City Imagine Awards now, which are designed to honor nonprofits that are excelling in their areas at an individual and an organization-wide basis. So really, so much of what we do as an organization, as a company ourselves, is for the betterment of the nonprofit community because it is an area that we focus on very much. So if there's anything we can ever do to help you in your capacity as nonprofit finance people or leaders, just let us know. We're happy to do so. I finished with a minute and a half to spare, so I'm going to look at the chat, see if there's anything new there. If not, we'll get that lease worksheet up there. Colleen, if you have specific questions, we can talk about that. It'll affect you for 2023, not the year we're dealing with now. Joel, thank you for joining. And I guess that's it. Thanks everybody for listening and watching, and have fun today with the rest of the update.